Okay. Mr. Shem, I hope you can hear me. So,
I can hear you, sir. Good evening, I can hear you.
okay, thank you very much. Good evening. Okay, that's very nice. So we're going to start from where we stop. So apology for late behind. I think we are this kind of getting too often. So and it's very unusual for us. But I believe going forward, all this will be fixed. So I actually apologize for that. So let's start the class. We stop at where last week? We stop at double entry where we're able to see the difference. We're able to see how our ledger posting from journals into ledgers and the rest. So I think we have a question left there. So let me just open and share my screen so that we can be on the same page. Okay. 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 I think I've seen that. So we have a question left on that previous material. So I'm sharing my screen now. So we all know, I believe you know the rules and the regulation about this. So what we're going to do basically is we're going to start the class now. We are going to complete where we started last class. And that is posting into journals and into ledger. So this time around, let's look at question 4. Question 4 happened to be the last question on this. That happened to be the last question on the material. So from there, we'll move to other area. So now, on question 4. So question 4 says, write up a three-column cash book for the following details. Balance off at the end of the month and show the relevant discount account as they will appear in the general ledger. So we are required to prepare what we call a three-column cash book here. So there's another topic that talk about cash book. So this is all our understanding of this question will help you to understand how cash book works. Because the reason why it's actually coming up here because cash book also has been referred to as journal, a proper journal. So example where journal also is cash book, and that's why it's coming up under this topic. So we have this to be, we have different type of cash book. We have a single cash book, we have two-column cash book, and we have three-column cash book. Now, a single column cash book or cash book is the one that have just the cash column alone. So to have the date, the particular, the amount, and the amount is for cash. But for two-column cash book, it means that it have both the cash and bank. It have both the cash and bank. But for three-column cash book, they will now add another column to it. And that column is discount received or discount allowed. Discount received or discount allowed. Now, the discount allowed will be on the debit side, while the discount received will be on what? Will be on the credit side. If you look at the solution here, let me show you what I'm talking about. Can you see the discount allowed is on this side, while the discount received is on this side? So they are what? The discount received is on the credit side, the discount allowed is on the debit side. And I would explain that also. So before we go into the question and start reading one after the other, I want to call your attention that when we talk about discount, we have two types of discounts. We have the cash discount and we have trade discount. Now, trade discount is a discount that is given to allow us to buy in bulk. Is a discount given to enjoy bulk purchase. It means that if an item is 10 naira, and if I'm buying 12, then I'll buy the 12 at 8 naira each. It means that what I've enjoyed, the 2 naira difference on each item is trade discount. And that trade discount does not involve double entry principles. It does not involve double entry principles because it's a discount that is given to encourage you to buy more. So at the point of payment, you have actually what? You are not paying the old amount, you are paying for the new amount that you have negotiated based on buying in bulk. So it is not going to affect or show in your financial statement. But the second discount is cash discount. Now, cash discount is the amount given to encourage early payments, to encourage any payment from our customer. It means that when you sold a good, let's say on credit for 20,000, you know, okay, fine. If you pay before 30 days or pay 2 weeks before the 30 days lapses, you are not going to pay 20,000, you're going to pay 18,000. That means that 2,000 naira that you're going to pay or not pay is subject to you taking advantage, subject to the customer taking advantage of it. So in your own financial statement, you are still going to record it as 20,000 because you are not sure if the customer will take advantage of it or not. And that is why that if the customer will take advantage of it, then you now need to now start to raise what we call discounts allowed. It's because you have allowed the customer to enjoy it. So the discount that you give out, the cash discount that you give out is what we call discount allowed. But the discount that you receive from your vendor, the one you enjoy from your vendor, is what we call discount received. Is what we call discount received. Now, it will be if we are keeping journal, if we are entering discount allowed, discount received figure in the account, in discount allowed account and discount received account, it might be too lengthy. And ability to trace it to each customer or vendors might not be that easy. So the way they do it is that whenever there is a discount allowed, under the 3-column cash book, we put that figure under that amount. Then at the end of the period, if it's weekly or monthly, all the discount allowed will be added together. It will now be taken to the discount allowed account. It will now be taken to the discount allowed account. The same thing also happens to discount received. When you receive the discount, because you have many vendors, so your discount received will be under your 3-column cash book. You'll be having under the column, because like a journal, that discount allowed, so you'll be recording it there. It does not involve double entry. You'll be recording it there. Once at the end of the week or at the end of the month, you total everything on that column. Then you now take that value down to your discount receive account. Discount receive account. So this basically, that is one of the purposes why we have the 3-column cash book, in order for us to what? To bring in the discount allowed column and the discount received column. And I said that cash discount involve what we call double entry. Double entry is because one account will be debited, another account will be credited. But we are talking about discount, trade discount. Trade discount does not involve double entry transaction. It does not, because we are not paying that money. Now let's go to question 4. So we are asked to write up a 3-column cash book. So we have October 2014. Balance brought forward, cash in hand is 780. Cash at the bank is 12,560. Now the question is now, where are we going to have it? Sorry, excuse me. Okay, so we have cash in hand, 780. It means the amount of money that we have with all is what? Is 780. Then at the beginning of it also, the amount we have in bank is 12,560. Now, this cash in hand and cash at the bank, they are current assets. They are current assets. And current assets always have what? Debit entry. It means that this amount will be found on our debit column, our debit entry, our debit side under the 3-column cash book. And 780 will be found under cash, while 12,580 will be found under bank. So let's see. This is what I'm talking about. So we have the date, we have the particular, we have the folio, we have the discount allowed, we have cash, we have bank, we have this. So this is the debit side. This is the debit side. Then we now repeat the same thing for the credit side. We repeat the same thing for the credit side. So at the beginning of the date, the October 24, the October 1st, 780 is under cash column. 780 is under cash column. Why the 12,560 is under bank column. So there's no addition, because the reason why we are putting that, like I said, cash book, this cash account and cash in bank, they are both current asset elements. Now, going forward, the other one that we now look at, let's look at the next transaction. The next transaction is the following persons pay their account by check in each case, deducting 5% cash discount. The following person paid their account by check, so it's by check now, which means that it's going to affect bank column, okay? And they have what? Discount of what? Paying what? Discount of what? Deducting 5% cash discount. Musa is 800, Kame is 600, Kaka is 200, Jibri is what? 1,200. Now, this one, you need to know if it discount received or discount allowed. Is it a discount received or discount allowed? Now, let's look at it. If you look at it here, we have it here. The reason why we're having it here is because they are customers. They are customers, not our vendors. So we have the October 2 year, and we have all the names listed. Can you see? Musa first. How much is Musa owing us? Let's check. Let's check this. Musa is what? 800. And they said that they are enjoying 5%, which means they pay early. So they will enjoy the 5%. There's two ways. Do 5% times 800. 5% times 800 will give us what? You can press your calculator. I believe you have your calculator with you. So let's do that together. 5% on 800 will give us, that's 40, if I'm right. Now, 40 minus 800, it will give us what? 760, which means the amount that we hit our account, that we hit our bank is what? Is 760. But that 40 naira will not serve as what? As the discount allowed. Because we allowed Musa to what? To pay us lesser than what is expected to pay us. So it's discount allowed. Now, if you look at it here, can you see that 40 here? And we have 760 here. So addition of 760 and 40 will give us a total of what? A total of 800. They give us a total of 800. So after that, another one that you need to look at is the second one. So let's look at the second one. So I'll just explain this and we'll move on. So we have Kama here, that's 600. So we have to find the 5% of it as well. 5% of this should be 30. 30 minus 600 will give us, that should be 570. Then we have Kaka as well, that's 200. 10% of 200, 5% of 200 will give us what? That will give us 10. That's 10 minus 200 give us 190. Then we have Jibri to be 12. 12, it means that 125, if you look at the 5% of 12 will give us 160. So give us 60 minus 12 will give us what? The total that we need. So 1,400. That's what we have here. Can you see? We have this to be this. Can you see? What? If we add the two together, they give us the total. Calculating of this as well. It will give us the total figure. We calculate this as well. It will give us the total figure. Now, we are not showing the second leg for this because we are only required to prepare the 3-column cash book. It means that if I open Musa account, I'm going to see this 760 under Musa account. If I open Kame account, it means I'm going to see 570 under what Kame account. If I open Kaka account, I'm going to see 190, which means that any names under this particular, once I click on it, I will see the respective figure under such account. And I'm okay that what I've actually done my double entry correctly. So let's move on to the next one. The next one says that paid rent in what? He paid rent in cash 120. Now, this rent we paid, rent is an outflow. It means that cash is given. Cash is not, we are not receiving cash, but we are giving cash. And the rule says that what? We should credit the giver. And also is that when your asset is reducing, you credit your account. And that is the reason why this rent is an outflow and it will be what? It will be credited into the cash book or into the cash book under cash column. Under cash column. If you look at it here, so my explanation and this will be the same, but let me just show you so you understand it. Can you see? It's under what? It's under the cash column. Is the rent, the particular is rent, but under what? Under cash column because it's cash. They pay rent by cash. The next one we have is pay T Musa is account by what? Or 670 by check. No discount be deducted. So this one is our what? We paid, we didn't receive. We also paid Musa. So Musa was, who do we pay Musa? How much do we pay? We pay 670 by check. If you pay by check, it means that it's going to affect our what? Our bank. Now, if you pay by check, sorry, let me see. Okay, pay T Musa, okay. Pay T Musa by check, that money is receiving. This means there's a way they should have explained this better. Pay T Musa, it means that Musa paid this amount to them because based on this solution, that's what it is treated. That it's received. It means that it's the people that receive the money paid Musa as T Musa by what? By check. So Musa paid by check of 670. So the company received 670. The company received 670. The other one we have there is, sorry, this paid T Musa. This paid T Musa is account of 670 by check, no discount, discount be deducted. This should be actually okay. If the same is paid and not received, that means that there's a typo. There's typo here. This should be received. It means that Musa paid us, so we are receiving it. So this should not be paid, please, because if it's paid, it means that we are paying Musa. It's going to be it's meant to be on the credit side. So 5 is on the debit side. Then it means that Musa is one paying the company. It means that Musa is one paying the company. Then we have also October 5th. We have cash sales paid directly into bank of 750. Now this transaction is what we call contra entry. Contra entry is any transaction that has been documented both on the debit side and on the credit side of the same account. Any transaction that appear both on the credit side and on the debit side of the same account is called contra account. It's called contra account. Now, if you see these, we have to look at cash sales paid directly into the bank. Now, cash sales, it means that we make sales in cash. So cash is actually what? Cash received the sales, but we are not taking the money to bank. So who is receiving the money at the end of the period is what? Bank is one receiving it, while cash is one giving. So under the debit side, bank is one what receiving. So bank will be debited while cash will be credited. Can you see that we have says here bank of 750? That's bank of 750. And the reason why I said that you have bank 750. Let me check that out. Okay. Oh. Mr. Oluwaseun. Okay, so please let me call attention to this. Cash sales paid directly. Cash sales paid directly into the bank. So it was a sales that was paid directly into the bank. So it means that what? The bank is one that receives it straight. So sales and bank. Now, assuming it was not paid directly into the bank, if it was from formerly cash, then you now take the amount, then pay to the bank. then you can write it as contra entry. But so far that sales, the amount was not firstly paid by cash, but it was paid directly into the bank, then we can regard it as what? As sales and bank. Okay? These are the little things that we actually need to be careful of. Cash sales paid directly into the bank, 750. So the sales is directly into the bank receive it, and that will be 750. Now, if you look at October 6, paid the following account by check. In each case, deducting a 5% cash discount. Account now 0200, 600, 360, and Gambo 800. Pay the following account by check. Now, this means that we pay this account. So we are giving out. Now, so far we are giving out, we now say that there is 5% discount. And this 5% discount is will be regarded as discount received. It will be regarded as discount received because we are the one paying. It's like they are our vendors. Our vendors have given us the go ahead to pay lesser if we are able to pay earlier. So basically, so far that we are enjoying that 5% discount, it means that we are going to 5% of the 200, 5% on 200, and that will give us 10. It means that the actual amount of money that we hit our account will be in 190. The actual amount of money that we hit our account will be 190, while 10 will be under the discount received. And the same procedure could go to the amount sold 600. Now 600 also 10% of it will be 30. It means that 570 will hit our bank, while 30 will be under discount received. While under 30 will be discount received. So if we look at it here, we have nursery, we have 10, we have the 10 year. After that, we have also 5 discount received here. We have also these 5 discount of it is what is 190, and we have Gambo also 5 discount of it with what is 40, and that's how we have it here. So next one that we have, let me see the next one we have, cash drawings. Cash drawings. Now, cash drawings is a form of the owners taking out of their capital. Drawings, anything taken out by the owners, not for the purpose of the business, is regarded to as drawings because it's taken out for personal use. It's taken out for personal use. Now, who is giving? It's cash that is giving. So cash is one that is reducing by what? By 400. So we state the drawings to be what? To be 400 because it's the cash is the one giving. Cash, we are reducing cash by 400. Then after that, we have also on October 11, K Frank paid his account of what? 890 by check, 850, deducting 40 cash discount. Is for deduct cash discount. The total from their customer is 90, but he withdraw what? He take advantage of the discount of 40. Now, since it's by check, it's going to be under the debit side, and 40 will be under the discount allowed, while the bank is what? 850. 850 plus 40 will now give us the 890 that he is expected to pay us initially, but it's not paying on 850 because it's paying earlier than expected. Then we have also cash withdrawn from the bank of 1,000 for business use. Now, this cash withdrawn from bank is contra entry. Contra entry in the sense that the transaction will occur both on the debit side and on the credit side. Now, the question is, who is receiving? Who is giving? Now, cash withdrawn from bank, it means that bank is the one what? Giving, while cash is the one receiving. So on the debit side, cash column will be what? Will be 1,000, while on the credit side, bank column will be what? Will be 1,000. So we have this here, bank, can you see on what? We have the under the cash column, we have the 1,000 because we are withdrawing cash. So cash increase. That's why the column, the cash column will increase. And this C that we have here is one that represents what we call the contra entry. then it means that on the second side of it also, you must find that you must be able to trace the second leg. And that is what we call, it's going to be found under bank, because bank is the one that is giving. Bank is the one that is giving. So we are going to put that 1,000 under bank, because you are reducing your bank balance by 1,000. Because you are reducing your bank balance by 1,000. Then the next one that we have is salary. On the 19th, it says that salary paid in cash. If you pay salary in cash, it means that your cash will reduce, your asset will reduce, and whenever your asset is reducing, you credit it. So we have salary. It's not by check, it's by cash. So it will be found under the cash column. Assuming it's by check, it will be found under the bank column. Now, if you move forward as well, under the next one, you see that it says that on October 20, the following persons pay their account by check, in each cash deducting 5% cash discount. Now, these poor people also say that what? There are some people that pay, they take advantage of the 5% discount, and the following person pay their account by check. Now, if they pay their account by check, it means that it's the account that we are keeping on their behalf that they paid. So they are paying money into the account. It means that they are customer based. Now, it means that once they are paying money, it will be found under the debit side, because it means that it's reducing our trade receivables. It's reducing our trade receivables. So we have this. If we find it 5%, it should give you this figure. 5%. If we have 5% of 1,470, will give us what? You give us 70. If 5% of 1,000, that also should give us what? 950. So 950 plus 5,000 will give us what we know as what? The 1,000 that we have. And the same procedure also applies to Bayo. 5% of the figure will give us 190. 5% of the figure. What is the figure I'm talking about here? I'm talking about 3,800. 5% of 3,800 will give us 190. 190. Okay. After that being said, let's look at October 25th. Internet borrowing in cash. Internet borrowing in cash. Internet, so it means that what? It's also internet browsing. Internet browsing in cash. Now, internet browsing in cash is 300. What does it mean? It means that the cost of browsing on the internet is 300, which means that we pay for that internet browsing with cash. And it means if cash is given, we are expected to credit the cash column. And that is why we are having it on the what? On the credit side. On the credit side. Then after that, the next thing we have is October 28th. October 28 says the perpetual pays a further 10,000 capital into the bank from his private money. Now, capital is actually what is a fund that is used to start up a business. Is the amount used to start up a business, or the amount used to increase or to invest. So it might not be just startup. Maybe when they are into the business, the addition of what of resources into the business by the owners, and also the gas to capital. Now, capital is an equity. If we introduce more capital, we expect to credit the capital account and debit what they introduce. If they introduce cash, we will debit cash. If they introduce assets, we will debit asset, because they are increasing. Now, this time around, they said that 10,000 capital paid into the bank. It means that bank is one that is receiving. And so far as the bank is one receiving, it means that bank column will be debited by 10,000. Debited by 10,000. Now, after that, the next one that we have there says that the balance, Bala Review paid 760. Bala paid 760 in cash. They paid 760 in cash, which means that what he have reduced his exposure to us by paying the 760, which means that cash received what? 760. The cash received 760. So we have this. He paid, so he paid to us. So we are the one receiving it, 760. And after that, what else do we have there? The other one that we have there says that the proprietary bank all the money in the office except 150. So he bank all the money in the office except 150. What does that mean? It means that every money that is expected that he remain, he banked them all except the amount of what? 150. Except the amount of 150. So how do we get that? Now, it means our balance. So what you need to do is to come here and state your balance carried down is what? Is 150. After you have stated your balance carried down is 150, you will now add up 120 plus 400 plus 800 plus 300 plus 150. That will give us a total of what? So let's add up. Let's add that up and let's see. Under the cash column, we have 120. After 120, what else we have? 400. What else we have? We have 800. After 800, after 300, what else we have? 150. 70, so 1,780 plus 760. 760. And that will give us a total of 2,540. We will now minus it. We have here that was taken from the business down to the bank. Remember, they didn't state. Remember that they didn't state the amount that we banked. They only told us that. Let's read it again, so that we can read it. They only told us that the proprietary bank all cash except 150. They only told us the bank. They give us the balance that we have as cash. Are you with me? So they give us only balance of cash balance, but they didn't give us their total amount that was bank. So it means that we need to work backward. Before, as me, they give us the total amount of money that was banked, or what we just need to do is to now find our balance carried down. But now they have given us our balance carried down to be 150. So now that we have our balance carried down to be 150, they will now say 2,540 minus 1,770. And that will now give us 770. Now, this 770 is a contra entry because it have a transaction, transaction between cash and bank. So it means that it will appear both on the debit side and on the credit side. Now, who is giving? The person that is giving is cash. Cash is giving. That's why we have it under the cash column. But the reason why we have it bank under the particular is because is the person that is receiving it is what? Is bank. That's why we have bank under the particular. Please try to be what? Careful, not to mix it up. The column that we are reducing is cash because it's cash that is giving. But the person that is receiving it is bank. So particulars will also be the person that is receiving it, which is bank. Now, if you come here, you see cashier. Cashier means that what is the respective, that the second account that has been affected. Then his bank is receiving the 770. So after you are done with that, we now add everything together. Now, if we add everything together, this one will give us 490. Your discount allowed is 490. Your cash is actually what? 5,000, 2,540. Your discount, your bank column is 34,220. Now that you have that, we now have discount received is what? Is 260. The discount received is 260. Your cash also is what? Is 2,540. Now, the reason why we have it there 2,540 is because we have done the balancing figure already. So we can easily add everything together and get that 2,540. Now, under the bank column, We now add everything together. If we add everything together, if we add 190, 570, 3,420, 760, and 1,000 together, it will not give you 34,220. It will give you a lower figure compared to this 34,220. Now, for you to get your balance carried down, you will now say 34,220 minus the total figure, and that will now give you what? 28,280. Now 28,280, it will not be your balance carried down. It means that this is the amount that you have in your account as at the end of October. So addition of everything together will now give you 34,220. Now remember, we are not done yet, because I told you in the beginning of the class that the reason why we have discount receive and discount allow is because we don't want to repeat informations continuously on discount allowed account and discount received account. So what we normally do is that we total every discount allowed together here, and we now post it into the discount allowed. Now, discount allowed account is an expense account. So it means that it's going to have debit entry. Now, that's why we have it here. Can you see? As at the first 10th, we have sundry to be 490. This 490 is the balancing figure from the 3-column cash book. It's the balancing figure from this cash book, and we now have the balance carried down to be 490. The reason why we are having balance carried down under the expenses is because it's not the end of the year. Once it is the end of the year, it will no longer be balance carried down. It will now be what? Profit or loss. It will now be profit or loss, which means that figure will be what is going to be posted under the profit or loss. The same thing also applies to discount receipt. Discount receipt is treated as income. So it will be what? It will be credited. So the sundry account will be on the credit side, which is 260. 260. Then after that, we have the balance carried down. Like I said, the reason why we have the balance carried down is because it's not in the end of the world. It's not the end of the year. If it's the end of the year, what we are going to have here is profit or loss. Is profit or loss. Okay. Now, I think that's the end of the that. So if you have, please, I will just give you a few minutes. If you have any question, you can ask a question. If there's anyone I explained that is not clear, please ask a question. So any question, please, our name just give you 2 minutes. 2 minutes. If there's no question, we enter the so we use the next, move on to the next material. Okay, I'll go to explain that again. The last double entry. Now, discount allowed, discount received, these are ledger. They are the one that actually involve what? Double entry. Remember, I said that cash discounts, actually what? Cash discounts involve double entry. It means that we are first of all going to what? We are first of all going to okay, let me look at another way. Discount allowed, discount received, cash discount, they are involved double entry. The number one is that it involves the discount allowed account. And it involves if the discount allowed, then it's going to affect your trade receivables. Now for discount received, if it's going to be discount received, then it's going to affect your discount received account and it's going to affect your what? Your trade payable. Okay. Now, if we are the reason why we now prepare this, like I said, cash book is also called, can be also regarded as what? As journal. Are you with me? So this now, for us to be able to trace our discount received and our discount allowed to a particular vendor or customer. That gives rise to what we call the 3-column cash book. And that's why we have the discount received column and discount allowed column. Now, at the end of the week or at the end of the month, the total figure under the discount allowed will be taken to the discount allowed account. The same to also the total under the discount received will be taken to the discount received account. Now, discount allowed is an expense account. An expense account is actually have what debit entry. Expense account have debit entry. And it means that that's why if we add everything together here, which is 490, you can find it at this what? At this debit side. You can find it at the debit side, which is 490. Now, the reason why you are seeing this to be what? Balance carried down. Yeah, the reason why we are seeing balance carried down because we are here to close that financial year. Discount allowed is found under profit or loss account. So we are expected to write it off to profit or loss account. But because we are here to prepare a profit or loss account, that's why we have it balance carried down. It means that we still have other figures to add up to it before we can now transfer to our profit or loss account. But assuming it is the last month, you are not going to have your balance carried down here. What you are going to have is what? Is profit or loss account. Expenses at the end of the period are written off to profit or loss account. The same thing to revenue. Revenue also are written off to profit or loss account. But assets, liability, and equity have what we call balance carried down because it means that even next year, we are still going to continue that figure next year. That's why under this, we have this or debit because it's an expense, it's reducing your profit. We have it to be 490. So the opposite is for discount received. So discount received is treated as what? As gain. So it's treated as revenue, as income to the organization. So, and revenue gain or income are what? Our credit entry. And that's why we have it on the credit side to be 260. Then we now what? The balance carried down will now be 260. But assuming we are writing it up, which means if it's the end of the period, we will now write it off to profit or loss account. That's why if you go further, if you prepare financial statement, you will see it under your financial statement. You see discount allowed under expense and discount received under income. And that's the reason why you need to know the difference as well, because so there are some trial balance I've seen. The trial balance, they'll just tell you discounts. They'll put discount there. They'll now put under the debit column, they'll put an amount there. Under the credit column, they'll put an amount there. It's not left for you to now decide which one is not for you to now know which one is expected to be credit, which one is expected to be debit. So, but now that I explain it, you know that any discount under debit column is for what? Is discount allowed. And any discount under credit column is what? Is discount received. Okay, I hope that is clear. If that is clear, let me know. Or if you have any more questions, let me know. Okay, thank you very much. So that means that we can move on to the second material. Okay, so let's move to the second material. Let me quickly share that now. Okay, I believe you can see my screen now. So this second material is to build up on what we have done so far, is to build up on what we have done so far. So what we have done is actually very, very important. So we are building up on it. Now, this is actually what we call adjustment to final accounts. Adjustment to final accounts. You know, when we prepare the like when we started the class, I told you the accounting process. I told you the accounting process, and I stated it that the accounting process is firstly is that we we analyze and collect data. Then after that, we post them into journal. Then after journal, we post it into ledger. Then after ledger, we post into trial balance. Then after trial balance, we adjust. We now have adjusted trial balance. Now, this adjustment to final account is actually the one that talk about adjustment trial balance. So it means that we are not trying to adjust the figure that we initially have in our ledger. The reason is that majorly there's an adjustment to be done on what? On a yearly basis on final accounts. It's not done during the month or during the week. It's not done during the month or during the week. It's actually done at the end of the year. It's done at the end of the year. And these are what we call the depreciation. They are bad debts, they are provision for doubtful debts, accrual, and prepayment. So it means that the ledger figure we have, the ledger balance that we have are good, but there's still something that we need to adjust from account on to actually reflect some figures, to reflect some transaction. Like I said, and these adjustments are basically 4, 5. The depreciation one. Following one is bad debt and provision for doubtful debt. Also, we have accrual and what? And prepayment. These are the adjustments that we need. If you know this adjustment, then you are good to go, because these adjustments are the additional information that they normally ask you to what? Whenever they enter, they ask you to prepare financial statement. They will not say additional information. The additional information is this adjustment that you are talking about. So the reason why I want to take it one after the other to break it down. Then we will now look at the question in totality. The reason why I want to break it down is that if I look at the question in totality, you might not understand easily. But if I break it down one after the other, at the end of the day, we now bring it together, you should be able to understand appropriately. You'll be able to understand very, very well. Now let's go on with that. Let's go on. We have the major adjustment. The major adjustment that are made to a final account are depreciation, bad debt, and provision for doubtful debt in our accrual and prepayment. So according to the IS1 talks about the according to IS1 actually talk about presentation of financial statement, and then we have what we call the assets. There later the element of financial statement, which I've explained earlier. We have the asset, we have the asset, liability, equity, income, and revenue. So one of them is the asset, and I said that asset is what is divided into two. We have your non-current asset and current asset. Now, assets are found under what? Under statement of financial position. Statement of financial position. Now, the reason why we find that statement of financial position is also formerly known as what we know as what the balance sheet. It's formerly what we know as the balance sheet. Now, non-current assets are assets that are useful for more than 1 year. They are often referred to as long life asset. It means it's the asset that they stay for a long period of time. Some stay for 3 years, 5 years, 7 years, 8 years, 10 years, 20 years. These are the assets that they are what? They are still useful. They still bring economic resources to the entity for a reasonable numbers of years. Now, if that is the case, it means that there are some treatment, there are some particular treatment that goes in line with it. According to IAS 16, there's particular treatment that goes in line with it. So IS1 also talks about measurement, type of measurement that we have. We have number one, we have initial measurement. Number two, we have subsequent measurement. Number three, we have disposal. So subsequent measurement also, or this when you dispose it, disposal of asset. These are the types of measurement that we have. Now, when talking about initial measurement is talking about, firstly, once we get an asset, that's asset here, not current asset that you are referring to is PPE. Once we purchase that asset, that's property, plant, and equipment, PPE, property, plant, and equipment. Example of them are land, building, equipment, and motor vehicles. Now, once we have them, how do we record it in our financial statement? The first year we purchase them, how do we record it in our financial statement? And that is what we call initial measurement. That is what we call the initial measurement. Now, according to the standard IAS 16, it says that any cost that is reasonable incur for us to use to bring the asset, to protect the asset and bring it to the state that will be ready for use should be all added together, and that will now form our total cost of the assets. Initial measurement. The cost of item of PPE consists of, number one, it consists of the purchase price. Number two, it consists of professional work price. Number three, it consists of any direct cost that is incurred from the purchase point down to when the asset will be readily for use, Then that is the figure that will now be recognized as what? As the cost of the asset under our statement of financial position. Example of the direct cost are, number one, cost of site preparation, professional fee, installation fee, assembly fee, testing cost, and the like, any direct cost. For example, if I purchase a motor vehicle from US, motor vehicle, the purchase price is there. If there's any discount, I will use that discount to reduce my purchase price. So it means that my purchase price will always be purchase listed price less this trade discount. Then after that, I will incur some cost to transport, shipping fee. That shipping fee also is relevant, is directly involved. I'm going to add that one to it as well. Then the next one also is that I'm going to incur custom clearing as well. That custom clearing also is part of the cost of the motor vehicle. That also will be added to it. And also, I will now add, okay, the cost of bringing it from that clearing point to the company also will be added to it. Then at the same time also, after I have all this, I'll now add everything together. If there's any professional fee, if the vehicle is not in good shape and I need to call some engineers to work on it, the cost of the engineers also will be added to it. So far, I've not used the asset at all. The cost of the engineer will be added to it. Then everything summed together will now be the total figure that I will use to cost my asset under my financial position. If it is a plant that you are talking about, when you purchase a plant as well, shipping the plant, cleaning the plant, assembling. When you assembly the plant, installation of the plant, even the material that you use to test the plant, when you are setting the plant, is also part of it. But during your testing, if there's any good one that you cannot sell, or any good product that you cannot sell, you have to reduce the cost of that the good one from the total cost of asset before you cannot say that, oh yes, this is the total cost of assets as regard to these plants that I have purchased. So that's what the standard is talking about, and that is what we refer to as initial measurement. Now let's look at one scenario. It says that the company purchased a large item of plant. The following costs were incurred. So we have this to be listed price of the machine is what? Is 1 million. This 1 million is the amount they advertise. It. But trade discount, we are able to enjoy trade discount of how much? Of 50,000. So far, we are able to enjoy discount of 50,000. It means that the actual purchase price will be 1 million minus 50,000. And that will give us what? 950,000. That will give us 950,000. Then after that, we have delivery cost. Delivery cost is direct cost, because if you don't incur the delivery cost, that asset will not be what? Will not be in place for us to use. Then we now add the delivery cost also is important. Then after that, we have installation cost. Installation cost also is what? Is a relevant cost. It's also a relevant cost. Then we have cost of preparing the site, also is relevant, because the asset is not readily available for use until we incur that cost of site preparation. They have to prepare the site that will bring the plants to. So it's actually part of it. Architectural fee as well is also part of it, because if it's directly related to the purchase of plants. Then we have administration expenses. These administration expenses is not what? It's not part, it won't be added to the cost of plant, because either we purchase the plant or not, we are still going to incur the what? Administration fee. So that 150 will not be part of the cost of plant. Now let's look at the solution. Now this is the solution that we have, like I explained earlier. 950 is 1 million minus what? 1 million minus 50,000. Then after that, we have delivery cost. After that, national cost, cost of site, architect fee, and that's 1,390,000. This figure is what we are going to see under our what? Our statement of financial position. And that means that we are going to debit plant. The reason why we are debiting plant is because plant is an asset, and an asset is increasing. So we debit plant account. Then we now credit bank if we are paying. But if we have not paid, we credit payable. But once we have paid, we credit bank, because bank is giving. Okay? And that's with what amount? We credit them with 1,390,000. 1,390,000. Now, improvement on capitalized there. So expenditure on the current asset after acquisition is treated as capital expenditure when it requires an improvement that is what? That is added to the cost of original asset. Now, this is what we are saying. These things actually, these capital expenditure and revenue expenditure, they are actually things that you need to know. Now, if we purchase an asset, and that asset you now incur a cost that is reasonable, the cost that we increase the useful life of the asset, the cost that we increase the output of an asset, the cost that we increase the longevity of the asset, it means that these costs that you have incurred, they are actually what? They are capital in nature. They are capital in nature. For example, I have a vehicle of 1 million. After that vehicle now needs what we call the engine. So I now purchase an engine of 500,000. That engine of 500,000, I must capitalize it. The reason why I must capitalize it is because if the vehicle is after, maybe the vehicle have 2 years left, and I purchase that engine now increases from that 2 years to 4 years, or that engine will now increase the capacity of what? Of the output that we are enjoying. Maybe I will drive it for 4 hours, but I can drive it for 6 hours. It means that capital, that 500,000 naira, should not be expense. It should be capitalized, because over time, it means that 500,000 should not be for just a single year, because we are still going to enjoy that benefit for 4 to 5 years. So that amount of money should be capitalized. But if it's for repairs, like let's say for repairs like changing of plugs, fuel, oil, grease, all this maintenance, there is a normal maintenance within maintenance, that amount will be expensed. That amount will be expensed. And when it is expensed, it's going to be found under our profit or loss account. But if it's capitalized, it means that we are adding to the what? To the carrying amount of the what? Of the asset. It means that amount of the capital amount will be found under the statement of financial position. It will be found under the statement of financial position. Now, And that thing also you need to know is depreciation. Depreciation is actually defined as the gradual failure in the value of what non-current asset arising from wear and tear, obsolescence, and passage of time. But according to IAS 16, depreciation is defined as thematic allocation of depreciable amount of an item of property, plant, and equipment over its estimated useful life. And let me explain this definition that will make you understand it better. Now, depreciation is a systematic allocation. It means that there's a way we allocate it to on yearly basis. So we are not using judgmental, we are not being subjective, we are not using subjective method to allocate, but we are using systematic. Systematic in the sense that it involves some scientific method of allocating what? What are we allocating? We are allocating depreciable amount of an item. It means that PPE actually depreciates. So this depreciable amount, the amount of the PPE that can be depreciated is what we are allocating systematic. Then over what? Over the estimated useful life. In 5 years, then the amount will be what? Will be allocated for 5 years. If the useful life is 10 years, then the amount will be allocated for what? For 10 years. That is how they derive at this definition. That's what is the systematic allocation of depreciable amount of an item of property, plant, and equipment over its estimated useful life. Over its estimated useful life. Now, there are various methods used to calculate depreciation. There are various methods used to calculate depreciation. But before we move into that, let's look at the terminologies that involve in it. Some of the terminologies is one, depreciable asset. I've explained this. Depreciable assets is actually an asset that have some features. Some of features like useful life of over a year. Well, the example of non-current asset, they have useful life of more than 1 year. Acquire primary for production of goods and services. Production of goods, if you are manufacturing services also, like what? Building, land, or building, land is not depreciable. Okay, so it was an asset. Building, motor van, or equipment, and the rest. Also, it have limited useful life. It's not for a long period of time. It will have period of like that depreciable amount that we are talking there, that we're talking about, depreciable amount. Okay. Okay. We are back. Okay, so we talk about that. So it have a limited useful life. It have a different useful life. Another one also is what? It's not intended for sales in ordinary business. It is not what? It's not intended for sales or ordinary business because there are some organization that motor vehicle what any organization that is sales of motor vehicle, it either will be an inventory. So that's the reason why it said that what it's not intended for sale in the ordinary business of the ordinary cost of the business. Then we have what we call residual value. Residual value is also known as the what scrap value. Is the estimated amount recoverable from the disposal of non-current asset after its expected useful economic life. Now, when you have used an asset and you now decide to dispose of that asset, the amount that you will receive from it is what we call residual value. Another name for it is scrap value. Another name for it is we have residual value, we have scrap value, we have so there's another name for it. So we have, but majorly it is widely known as residual value and scrap value. Residual value and scrap value. So obsolescence means that it's old, which means that the factor which render a non-current asset useless, even though it is what it is still in good shape. It means that obsolete is old, it's no longer in vogue again due to technology changes and the rest. These are what are obsolete. So if it's obsolete, it means that what there's an impairment. It's not that you cannot give it what's called, but big on based on the technology, changes in technology, or based on consumer taste, is actually what it can, the asset is no longer functioning or okay again. So basically, we are going to look at three methods of depreciation. Depreciation, three methods. So we are going to look at number one, straight line method, number two, reducing balance method, and we are going to look at revaluation method. We have also other method. We have some of the year digit method. We also have, I think we have like 6 or 7 methods. So, but let us restrict it to just this. Okay. Now, the first method is straight line method. Under this method, the cost is actually what? Under this method, what we normally use is we do cost minus scrap value divided by useful life. It means on a yearly basis, the depreciation amount will be equal over the estimated useful life of the asset. And what it means that what the amount that we depreciated on a yearly basis will be the same over the estimated useful life. And we have an example here. Like I said, the formula is cost minus scrap value or residual value or salvage value. They can also call it salvage value. So we have salvage, it means that the amount that you're able to salvage, to recover from the disposal of the asset. So we have cost minus scrap value divided by useful life in years. So we now have an example of this, a machine. So let's look at example 1 here. Example 1 says here, a machine costs 100,000. It has an estimated useful life of 5 years. The salvage, okay, can you see this salvage? The salvage value at the end of the 5th year is estimated to be 10,000. What is the annual depreciation? Annual depreciation. Depreciation is calculated on annual depreciation. So how do you get this? Just look at the formula. Cost. What is our cost? Our cost is 100,000. What is our scrap value? Scrap value is the salvage value, which is 10,000. 100,000 minus 10,000 will give us 19,000. Now, how many years is this life? What is the estimated useful life? 5 years. So it means that we want to allocate the depreciation over the 5 years. So we now say all divided by 5, and that will give us 18,000. It means that year 1 is 18,000. Year 2 will be 18,000. 18 plus 18 will now give us what? Will give us 36,000. So which means that after 2 years, we have enjoyed 36,000 of value out of the asset. At the 3rd year also, we enjoy an additional 18. At the 4th year, additional 18, like that. So that's the way that's the way we systematic allocate depreciation. Can you see that? And that depreciation is found under where? Is found under statement of financial performance, which is profit or loss account. Statement of financial performance, profit or loss. Depreciation is found under the word statement of profit or loss account. Is found under statement of profit or loss account. Why the okay? Let's continue. So under method. So anyone you have, once you put in the formula here, you are good to go. The next one that we have is reducing balance, just like the word says, reducing balance. This is actually a method that we use percentage. We use a percentage to what? To multiply the carrying amount. We use percentage to calculate the carrying amount, not the cost. There's a difference between the cost and carrying amount. The carrying amount is what is also known as the net book value. Net book value is what? Cost minus accumulated depreciation. Cost minus accumulated depreciation, or carrying amount minus what? Depreciation for the year. Carrying amount minus depreciation for the year. Anyone you use, you are what? You are good to go. Now, accumulated depreciation means that is the depreciation that you have added over the years. Accumulated depreciation is the depreciation that you have added over the year. Depreciation for the year is the depreciation that is what? That is being attached to that year. Depreciation is one that is being attached to that year. So now let's move on. So after that, what again we are? We have that also to be formula for it. So question two is that we are having a machine costs 100,000 is to be depreciated at 20%. What would the depreciation expense at the end of the third year using reducing balance account method? So at the third year now, they ask us at the third year, not the first year. So it's 10%. The cost of the asset is 10%, and we are expected to what, to 20%. Now, if you look at it now, that 20% means that the asset will be what? Will be existing for 5 years. That's the meaning of that 20%. Because 20% in 5 years will give us 100%. So which means the machine cost, the machine will only exist for 5 years. Now we are expected to now reduce it by 20%. So in first year will be 20% times 100,000. That gives us 20,000, right? So we'll now do carrying amount. So 20% times the carrying amount. And I said that carrying amount is what? Is the cost of assets minus accumulated depreciation, or carrying amount for that period minus the depreciation for the year, minus depreciation for the year. Now, if you look at it here, end of the first year, it will be 20% times 100,000, and that gives us what? 20,000. The second year will be what? 20% times what? 100 minus 200. The 100 there is the cost of asset. The 20 year is what? Is the depreciation for the year. And we have that to be 16 depreciation, the previous depreciation, to get your carrying amount, and that will be what? 16,000. We now have what? End of the year is 20%. Now, after we have this 20%, we have 80,000. How do we arrive at 80,000? This 100,000 minus 20,000 will give us 80,000, which means the carrying amount is what? Is 18,000. So minus the 16,000 will not give us what? The net book value, the carrying amount at the beginning of third year. And that will not give us what? That will give us a total of, let's see, 64,000. So 20% of 64,000 will not give us what? 12,800. Or like I said, the other way you can do it is that you can do 100,000. So accumulated depreciation will now be 20,000 plus 16,000, isn't it? 20,000 naira. That's, if you want to use the former one, we talk about cost minus accumulated depreciation to get it. You look at cost. The cost is 100,000, right? Now the accumulated depreciation is mean that the depreciation that you have charged over the years, and that will be 20,000 plus 16,000. 20,000 plus 16,000 will give us what? 36,000. 36,000 minus 100,000 will give us what? Will give us 64,000. And 64,000 times 20% will give us what? 12,800. Then you are good to go. You are good to go. The other method that we need to talk about also is the evaluation method. Evaluation method. Okay, when we talk about IAS 16, I'll touch on this. So evaluation method is actually all about the evaluation method. Under this method, the value of the asset at the beginning of the year is added to the cost of the asset purchased during the year from the figure obtained and the value of asset of the year end is deducted to arrive at the depreciation. Okay, this is what they are talking about. What you're talking about is the evaluation. You revalue, you look at what the cost of it. So at the beginning, you have a particular figure. You add, if you purchase anything during the year, you add it to it. So at the end of the year, we now have what? We now let's say, okay, what is the value of the asset in the market? Are you with me? You now go, what is the value of the asset in the market? So if I have 20,000 naira before, then after that I now add another 5,000 to it. That my 25,000. That my total asset is 25,000, right? And now look at the end of the year. If I want to sell off this asset, how much will I sell it off? If I want to sell it off as 15,000, it means that my assets have depreciated by how much? 25,000 minus 15,000, and that will give me 10,000. That's what you are talking about. That's revaluation. You are revaluing, checking what? Checking the asset against the fair value. Checking the asset against the fair value. So let's look at question 3. Let's look at question 3 that helps us to explain that better. Ade has a van worth 20,000. Ade has a van worth 20,000. At the beginning of the year 2014, during the course of the year, he purchased additional 10,000. During the course of the year, he purchased additional what? Additional additional 10,000, and they value the total worth at the end of the year to be 25,000. So what is their depreciation? So at the beginning of the year, you have 10,000, and then he added another 10,000, which means the total cost of his asset is what? His motor van is 30,000. But at the end of the year, not only that, this asset I'm having, I want to let it go. The fair value market, the fair value, the market value at is what is 25,000. It means that the cost of carrying my asset is too much. I need to depreciate it. It will now be 30,000. So I have my value at the beginning of the year plus the cost of the year will give me 30,000. Then after that, I will less 25,000 naira for me. Will now give me 5,000, which should be used for to depreciate for the year. Which should be used to what? To depreciate for the year. So basically, that's how we would calculate the depreciation. We also have the sum of the year digit as well. That one is talking about if it's going to have for 6 years, you now add everything together 1, 2, 3, 4, 5, 6. Then for your first year will now be say 1 divided by what? 6 multiplied by what? By the number of the by the cost of the asset. You can look into that as well. But basically, what I'm explaining right now is what I've explained 3. You can Google and have more and check more out. And if you need more explanation, please let me know. I'll surely explain to you. So let's move on to the accounting treatment. Let's move on to the accounting treatment for depreciation. Now, when it comes to the accounting treatment for depreciation, we have 2 ways of accounting for our depreciation. The first one is we have the machine account and we have the depreciation account. The first method is we have the machine account and we have the depreciation account. While the second one is we have the machine account, we have the asset, not machine, let's say asset. We have the asset account, we have the accumulated depreciation account, then we have the depreciation account. The first one involves 2 steps, the second one involves 3 steps. Now, the difference between the first one and the second one is actually what is very simple and glaring, okay? But I will explain the 2 methods to us. So the first method says that the asset account can be calculated with the expense. The asset account can be credited with the expense and depreciation account debited, e.g., using example number 1 as example. So they ask us to use example 1. Example 1 is the one that talks about the straight method. Talk about the asset of the cost of asset is 100, the residual value is 10. So I have to use that. So now if you want to use that, the first thing is you have to start with machinery account. So you open machinery account, you open depreciation account. Once you open a machinery account and the depreciation account, you know an asset is what always have credit debit item. An asset account always have a debit entry. So we have that here. So we have that. Can you okay? So that for better understanding, I will just color it. So we debit that cost of it 100,000. Now, after the 100,000, we have depreciated it. Our depreciation for the year is what? Is 18,000. Our depreciation for the year is 18,000. And depreciation is used because it's an allocation of the benefit that we have enjoyed. Systematic allocation of what? Or depreciable amount. So it means that for that year, we have enjoyed this asset, 18,000 naira value of the asset. So we need to reduce the 100,000. The 100,000 is like, this is what is available for us to enjoy. Then for the first year, we have enjoyed 18,000. Then we do that, we put what? We credit the 18,000. Then we come here and debit what? And debit that 18,000. And then after that, we now balance it up. This is expected to be what? This account, if it's on monthly basis, it will be balance carried down. But if it's at the end of the year, it will be what? It will be written off to profit or loss account. It will be written off to profit or loss account. Now that we have the 100,000 here, we now be 100,000 minus 18,000, we give us what? 82,000, which means the balance that is left for us to what? To enjoy from the asset at the end of year 1 is 82,000. And this 82,000 is what we refer to as the what? Either the net book value or the what? The carrying amount. That is 2,000 is what we got to our carrying amount. So because is the balancing figure, is the figure that balance both the debit side and the credit side. Now, moving on, let's look at the second method using the same example. For the second method, the asset account will remain the same. The asset account will not change. It will remain the same. So we have the cost of the asset to be 100. Then even for the year also it will be 100. Continue for the next 5 years. The figure will remain the same for the what? For the second method. So the second method, the asset will be what? It will be left intact. It will be left intact. Then the other account that now holds on to that depreciation account is the accumulated depreciation. Is the accumulated depreciation. So accumulated depreciation, we now have what is the depreciation? The depreciation is 18,000. So we credit it. Instead of us crediting the asset account, we credit the accumulated depreciation account. Then we now debit the what? The depreciation account. Now, if we want to prepare our financial statement under the statement of financial position, this total year accumulated depreciation will now be used to reduce this 100,000. We use to reduce 100,000 to now get our carrying amount. Okay, so but under this method, your asset account remain the same, but your accumulated depreciation changes over time in line with what? With the depreciation account. So they now write it off to where? Like I said, we write it off to POL account. Write off to POL account, but this one will be balance carried down. This one will always be balance carried down. This one will always be balanced carried down. Okay. Now, the way it's going to appear, is this. Can you see? So we have this is an extract. We have the machine to be what? 100,000 if this will not change, and we have the accumulated depreciation to be what? To be 18,000. So 100,000 minus 8,000 will give us what? 82,000. Now, for the second year, if it's for the second year also will not be under this one. We are going to have depreciation again, 18,000. Then we have for the year. The depreciation for the year will also be what? 18,000. So our total accumulated for depreciation for the year for year 2, our total accumulated depreciation for year 2 will now be 18,000 plus 18,000. This 100 will still remain the same. 18,000 plus 18,000 will give us 36,000. They will now come here and now say 100,000. This one will now be 36,000. Now be 100,000 minus 36,000. To now give us what? To now give us the carrying amount that we have. Now 100,000 minus 36,000 will give us, that will be 64,000. So this place will now be 64,000 as the carrying amount. The third year also, it means that we are going to add another what? Another 18,000 under the accumulated depreciation. This one also will now be what? 18. That's for that year again, 18,000. We will do the same thing as well. So 18 plus 18 plus 18 will give us figure, and we do the same thing. Yeah, that's the second method. That's what the second method is talking about. Don't worry, when you use figures, you understand better when you get to when we prepare the financial statement. So the next one that we have also that we need to know as regard to the adjustments or final adjustment on financial statement is when it comes to asset, is what we call gain or losses on assets. There are scenarios that involve us for dispose of an asset. And when you dispose of an asset and an asset is no longer useful, then we let it go. Now, when you dispose of an asset, there's another way we calculate for it. When you dispose of an asset, you want to ask yourself, do you make gain or do you make loss? Do you make gain or do you make loss? That's one of the questions that you need to ask yourself, either gain or loss. So anytime you see the disposal of an asset, you must calculate if there is gain involved or loss involved. And how do we calculate that? In vertical format, the formula says that sales proceed on disposal. That's the proceed, the amount that you sold that asset, then minus carrying amount, minus carrying also. Okay, let's go with this. We have sales proceed on disposal. Okay, you have it here. That's the first one. Then next one is less cost, disposal cost. If you incur any cost to dispose it, probably for marketers, you have to involve marketers or some professionals to sell it, or you advertise on a particular platform before you can sell the asset. You have to less it from the what? From the sales proceeds before you can get your net disposal value before you can get your net disposal value. Now, once you get your net disposal value, you now minus your what? Your carrying amount. You now minus carrying amount from it. And what do you understand by carrying amount? Carrying amount is the cost minus accumulated depreciation. I didn't say cost minus depreciation. I said cost minus accumulated depreciation. It means that if the asset has been existent for 5 years, it means the total depreciation for that 5 years will be added together and we use it to less the cost of the asset before we can now get our carrying value or amount. Now, once we have that, you now use that to one net off. Now use that one to reduce our net disposal value. So it means that net disposal value minus carrying value will either give you gain or loss on disposal. It will either give you gain or loss on disposal. It's going to be gain if your next sales sales proceed is actually more than your carrying amount. But it's going to be loss if your net proceed is lower, is lesser than your carrying amount. If in my book I'm saying my cost of asset is 20,000, and at the end of the day I sold the asset for 15,000, it means I've made lots of 5,000. Or if my asset is saying it's 15,000 and I sold the asset for 25,000, it means I've made gain of 10,000. So I have to account for it. So how do we account for it? Let's look at solution. Let's pick with question and let's solve it with a question. Now it says that example 4, a non-current asset costs 96,000 and was purchased on 1st June, year 1. Its expected useful life was 5 years and its expected residual value was 16,000. The asset is depreciated by straight line method. After that also, the asset was sold on September year 3 for 68,000. There were no disposal costs. There were no disposal costs. In the what? In the company policy, to charge disposition on a monthly basis. So the financial year runs from January 1st to 31st. They say, okay. So it runs from there to there, right? So let's look at that. Okay. So in order for do this, the next first thing for us to what? The next is for us to pick up the sales proceed. So we look for sales proceed based on our formula. Look for sales proceed. Where is our sales proceed? Sales proceed. I'm trying to locate it here. Okay, this is it. Is it what? The asset was sold on 1st. The asset was sold on 1st December year 3 for 68,000. That's our sales proceed, 68,000. So we have it here. So we have the sales proceed here. Then the next thing for us to pick is what? The next thing for us to pick is to pick the carrying amount to get the carrying amount. And the carrying amount is as a result of what? Cost minus the accumulated depreciation. So now what is the cost of the asset? The cost of the asset is 96,000. So the cost of the asset is 96,000. So we have known this. So we have picked this to be what? To be this figure. And we have paid cost to be what? To be 96,000. So our next thing that we know where we need is so we have used this figure. So we have used this figure. So the next one is for us to get the accumulated depreciation. Now accumulated depreciation it is expected useful life is 5 years. It's expected to be 5 years, right? And we purchased in what? 1st July year 1. Okay, that's good. Okay, so they talk about the residual value is what? Is 16,000. So if residual value is 16,000 and they expect us to use straight method. So if you are expected to use straight method, that the what we have to calculate. How do we calculate that? We now do what is the cost? 96,000 minus what? Minus 16,000 divided by 5. And 6,000 minus 15,000. So let's pick our calculator. Let's pick up our calculator and let's press. Let's confirm that. So now be 96,000. That'll give us 80,000 divided 16,000. That'll give us 16,000. Okay. Now that we have that to be 16,000, so we have that to be 16,000. Now that 16,000 is for what? It's for the year, isn't it? It's for the year. Now 16,000 divided by 12 will give us what? Will give us, so for the year is what? For the year is 16,000. So for 1 month, if you divide it by 12, for 1 month it will give us 1,333.3333, right? Now, after we have known that, we now need to count. So how do we get our accumulated depreciation? We now start counting. Year one. In year one, first, so we use the month of June. That's June, July, August, September, October, November, December. That's 7 months in year one. In year two, how many months is that? 12 months in year two. That's 12 plus 7 will give us what? 7, 8, 9. 19 months. We have 19 months already. In year three, we use for how many months? We use for January, February, March, April, May, June, July, August. We use for 8 months, up to what? August. We use up to August. That's 8 months. So we now have, we have first one is we have 7 months plus 12. That'll give us what? 19 months. 19 months plus 8. That'll give us 27 months. It means that the total month that we use for the asset is 27 months. I believe you understand how I get that. That's 27 months. Year one, June to December is what? Is 7 months. Year two, January to December is 12 months. Year three is what? Year three is January to August. That's 8 months. So 7 plus 12 plus 8 will give us 27 months. And how much is what? What is the allocated depreciation for each month? Is 1,000 and what? 1,333.33. And that's what we have here. So we have the 27,000 times 1,233 will give us what? 36,000. Please, if you place your calculator and you're not getting 36,000, let me know. Let me know. So it means the accumulated depreciation associated to that asset is 36,000. And 96,000 minus 36,000 will give us 60,000. Now, if the cost, if we dispose of the asset is 68,000, then we are saying that the carrying amount is 60,000. So then it means that what? We have made gain of what? Of 8,000. How do we account for this 8? This 8 here, it will be found under what? Profit or loss account. The 8 will be found under the profit or loss account as gain. It's going to find it under as gain. So let's look at the accounting process for disposal of assets. So this is the what? This is workings. This is the workings, and you are good to go. Then we now look at what? The accounting what? The accounting for disposal of assets. The accounting for disposal of assets is actually very straightforward. It's very straightforward. Firstly, is that you start with the cost of the asset. So you have to write off the cost of the asset from the what? From the asset account. So you credit the asset account with the cost of the what? Asset that you are disposing of. Then you do open a new account called disposal account. Then you now debit disposal account of that amount, because it means that on that disposal account is where you want to work. So you are taking it away. Now, since you have taken your cost, your associated cost away from your asset account and taken it to a disposal account, you need to do the same thing also to accumulated depreciation, because the accumulated depreciation is the one that is still holding that what? That or depreciation of the asset that you have disposed. Now, if you want to do that, that means that you have to debit the accumulated depreciation account and now credit the disposal account and credit the disposal account. Once you have done this second step, you are now left to just a single step. And that single step is what? Is the sales proceed. No, your bank receive it. Once your bank receive, then you now what? That means that your disposal account will be what? Is one given. So you have to credit your disposal account. So when you credit your disposal account, then the balancing figure of what? The left and the right hand side will now tell you if it's gain or loss. if the balancing figure is on the debit side, is gain. But if the balancing figure is on the credit side, is what? Is loss. Okay, so let's look the initial example that we are talking about. Now, the initial example is, I'll start with this asset account. So I have my cost. This is what is existing before. I have this figure to be existing in my account before, which is 96,000, right? Now I want to dispose of my account, so I'm writing it off from the what? From the asset account. So if I'm writing it off, if I want to take it off, I'll credit item, because I'm reducing the asset. And the law says that whenever an asset is reducing, I should credit it. So I'm crediting this. Well, this is disposal account. So it means that if I'm crediting this assets account because of disposal, then I need to do a debit disposal account for the asset. So I've done the double entry for these two. The next one, I'm going to move to the accumulated depreciation amount. Now, this is the balance brought forward. This is the balance that we have as the accumulated depreciation. Then the associated what? Accumulated depreciation for the cost of what? Asset that we are taking off or disposing is what? Is 36,000. So I need to what? I need to remove it. That's the second part. You know, and we talk about the what? Initial what? Initial measurement. You know, with the beginning of class, we talk about initial measurement. Later on, we talk about subsequent measurement. Then we talk about disposal. Are you going to me? Now, we have talked about subsequent measurement. Subsequent measurement is talking about when we talk about the capital expenditure and revenue expenditure, we're adding to it or we are taking out of it, that subsequent measurement, or re-evaluation. We are re-evaluating it, that's subsequent measurement. But this time around, we are talking about the word. This one is disclosure on the recognition measurement. This means that what? We are removing it from our book. We are recognizing it from our book. So after that, so once I've done this accumulated depreciation, it's no longer in my custody. So I need to remove the associated accumulated depreciation away from it. Then if I remove it away from it, the account that will receive it is what? Is the disposal account. The account that we remove it is the disposal account. This on the left-hand side, right? This is on the right-hand side. Then after I've done that, the next thing I need to do now is the proceed. Who is receiving the proceed? My bank is receiving the proceed because the money paid into the bank. But who is what? So the other one, I was okay, now who is receiving? The bank one is one giving it. This person is giving it. The disposer is giving it. The bank is what? It's receiving. So now, once I've done this, then I can now what? I can now look at the balance figure. 36,000 plus 68,000 is what? Is 104. Then I only have 96,000 naira here. So which means that 96,000 minus 104 will give me what? 8,000. The balancing figure is 8,000, and that is what we refer to as gain. Assuming is found on this side, on the credit side, is regarded to as what? As loss. So far is found on this side is regarded to as gain. So 96 plus 8,000 now will now give us what? Will now give us 104. 104, 104. So that is actually how we calculate what? Disposal of an asset, or what? Disposal, or if that's how you calculate gain on disposal or loss on an asset. Okay. So before we move on, so let me just quickly, before we ask for a question, let me explain this also. There are times also that you do part exchange. There are times in where you do part exchange. When you do disposal of property, plant, and equipment, part exchange of an old asset. For example, you have a phone that you are using right now. So when they release a new phone, you want to what? You want to exchange it. So you are selling it for you to get another one. Let's say, for example, iPhone 11. You are using iPhone 11 at the moment. So when iPhone 12 comes out, what you want to do is to exchange it. So you go to the store and say, fine, I'm going to drop my what? I'm going to drop my iPhone 11 and I'm going to have some cash to it so that you can give me iPhone 12. That we are doing swap. So that's also have some ways in which we calculate it in an account. The first thing also you have to calculate if there's loss or gain there. And at the same time also, you will have to watch. There are some little differences in their computation. So let's look at this example. A company has several motor car. A company has several motor car. A company has several motor cars that are accounted for as non-current assets. As at 1st January year 2, the cost of the vehicle cars were 120,000 and the accumulated depreciation was 64,000. During the year, during January, the company bought a new car costing 31,000 and was given a part exchange allowance against an old car, 8,000. The car being part exchange on originally cost 28,000 and its accumulated depreciation is 18,000 required. Calculate the gain or loss on disposal of the old car. B. Show how the purchase of new car and the disposal of account of the old car will be recorded in the ledger account. So this time around, there's part exchange. What he's saying is that we actually what a motor vehicle was let go, and a motor vehicle new one was given 31,000. So we need to calculate how much we actually is there gain or loss on it. So their first thing is for us to identify the sales proceed to calculate our A. Calculate what sales proceed, find out the sales proceed. So say this one says that if you look at this part, and was what giving a part exchange allowance against an old car of what 8,000. So the value of the old car is what is 8,000. The value of the old car in the new car purchase of new car, it was what 8,000, which means the sales proceed is what 8,000. After you have calculated our sales proceed, they didn't give us any there's any cost on disposal. So far they didn't give us any cost on disposal. What next is that we move on to what the carrying amount. How do you get our carrying amount? When I say carrying amount is what cost minus what accumulated depreciation. What is the cost? They told us that the car being part exchange was originally what 28,000. Yeah, can you see? And the accumulated depreciation is what is 18,000. So if that's the case, it means that 28 is my cost. Why what an accumulated depreciation is what is 18,000. And if I minus them together, it means my carrying amount as at that moment is 10,000. But what is the amount? Is 8,000. That's why swap or part exchange is not a good deal. It's not a good deal because the person who will reduce lowball you or reduce it to what to more than the market price. So we have this. So 8,000 minus 10,000 will now give us 2,000. 2,000 here is a loss. Is a loss because you're carrying it and you figure that your carrying amount is 10,000, whereas you are able to realize 8,000 out of that 10,000. So it is a loss. So the B partner says that we will show how the purchase of the new car and the disposal of the old car will be recorded in the ledger account. So how will these two be recorded in the ledger account? Straightforward. What we mean is that if you look at these, where you will, okay. So we start with what? With the motor vehicle account. Let's start with the motor vehicle account. They gave us the balance. So we figure at the beginning of the year 2, they told us that the total vehicle is what? Is 120, right? So we have the balance brought down to be what? To be 120. After we have the balance brought down to be 120, let's read on. Let's say accumulated depreciation for it also is what? Is 640. 64,000 rather. So if it's 64,000, so we have the next one is to open the accumulated depreciation account and say balance. This will be balance carried brought down, not carried down. Balance brought down. So the balance brought down, this should be BD, not CD. To us, 64,000. After we have that to be 64,000, what else? Any other figure? So they told us also that what? That during the year, the company bought a new car of 31,000 and was given a part exchange of 8,000. Now, if you bought a new car of 31,000, what does that mean? It means that the question you have to ask yourself that did they pay 31,000 or did they pay less than 31,000? Now, he paid less than 31,000 because as another cost, as another asset that have been what? That have been valued before he can what? Before he can come, before that 31,000 was reached. So he did actually pay that 31,000. He paid less than 31,000. The amount that was actually paid was 31,000 minus 8,000, and that will give us 23,000. And that and when since there's an asset that is increasing, what we do is that we credit what we debit the asset. So we have the new asset to be 31,000 minus what? Minus 8,000. But that's not the cost of the asset. Because the cost of the asset is 31,000. So we now notice also disposal of asset 8,000. Disposal of what? Of the asset of the 8,000. Now, if you look at here, you now so if you look at the second leg will now be what we find here. Can you see the second leg is found here as 8,000? That's motor vehicle disposal of what the asset is. That what is the disposal of 8,000. Then after that also we now look at the sales, the purchase. We said that a purchase amount, the actual amount the purchase is 23,000. So if you purchase 23,000, then it means that our bank will be giving what? Our bank will have given out 23,000. It means our bank are giving out 23,000. Where's our bank? Okay, this is our bank. Can you see this is the bank? This is the bank that has given out what? 23,000. If my bank has given out 23,000. Then the next one is one for us. Okay, how do we account for our depreciation? So we dispose of what I say, what the total cost of asset we dispose 28,000. That's number one. What another one we do what? If we dispose it all, then it will become fine under our disposal account. That's 8,000. Now, after that, we have to what? Remove the accumulated depreciation away from it as well. The accumulated has 18,000 given to us. It will become, you have to see it under it as well. This is 18,000 disposal account, 18,000. So after we have that, we now what? We balance it up. Next thing is for us to now balance. Now if we balance this up, oh, this wasn't balanced. So if you want to do this, you have to 120 plus 23,000 plus 8,000. We give a figure minus 28,000. That will now be our what? Our balance carry down. That will be the cost of motor vehicle as at the end of the period. So you are expected to have a balance carry down here under disposal. Balance carry down under this disposal. Then also accumulated depreciation account. If we add this together with 18, this is 64. 64 minus 18, because this is not existing at the moment. So 64 minus 18 will not be 48, which means that the total accumulated depreciation that is available after you have disposed is what? Is 48,000. It's 48,000. Then also you do a bank, that's bank, you do at your bank, then you do at your account disposal. So we have 28,000. 18 plus 8 will give us 26,000. And 26,000 is lower than 28,000. So 28,000 minus 26,000 will give us 2,000. And this 2,000 is a loss. Now it's a loss that we have calculated initially. So we have that to what? Loss. And this loss will be written off to where? Off to your profit or loss account. It will be written off to all your profit and it will be on the debit side, not on the credit side. Gain will be on the credit side, while loss will be on what? On the debit side of your statement of profit or loss account. Will be on the debit side of statement of profit or loss account. Then another one also I want to talk about is just disclosure. So there are some disclosure that is required. One part of it is that according to the IAS 16, that disclosure of what the method that we are used to value your asset must be, to measure your asset must be disclosed. We have two methods. We have the cost model method and revaluation method. These are the two methods that is used to cost your asset. The other one is what we call the depreciation method. The depreciation method that you use also must be clearly stated. You must state the depreciation method that you are used, and you must be consistent. You must be consistent. The useful life of the what? The useful life or depreciation rate must be stated. If you pick any financial statement, any financial statement, you see all this information there. The gross amount and the accumulated depreciation at the beginning and at the end must be, and that's what we talk about the schedule. We're talking about the schedule of asset schedule. Asset schedule will always show the what? The carrying amount or the gross carrying amount and the accumulated depreciation at the beginning of the year and at the end of the year. And from there, you see how it has been reconciled, how you reconcile the amount over the year. So basically, these are the disclosure that is expected from you under the that's expected from you. So I think that will be that for tonight. So if you have any question, please ask your question. Now, if you look at question 1, I have like how many questions there? I have 4 questions there. So please make an effort to practice this question. So if you bring after practice this question and you don't get it, I will send solution to you. Okay, but practice this question. And when I say practice this question, I'm not saying you should wait. Please, at least in the next 2 or 3 days, you should be able to have practiced it and send me your solution, and I'll go through it. So please, your question 1 to question 4 will test your knowledge and understanding on what we have done so far today. So let me know if you have any question. Let me know if you have any question before we call it a day. So please, any questions so far, Mr. Sheung? Is that Shannon? So any questions so far? Mr. Shem, are you still with me? One more minute. If I don't see any question, I'll call it a day. Okay. So since there's no question, we shall meet in the next class. Thank you for tuning in. I appreciate your patience and I appreciate your effort. See you in the next class. Bye for now.